The 2024 Canadian federal budget was just released last week, and it had a few proposals of note. I'll do my best to keep the political commentary at a minimum. However, I will tell you that the words fair and fairness were mentioned 233 times in a 430-page document. Fair? Fair. Fair? So here's to hoping that if they say it enough times, it becomes true. In light of all of that, I will do what I can to provide counterfactuals, aka bust some myths, and make it so that it's practical for you. In this budget, the lifetime capital gains exemption was raised to $1,250,000. The home buyer's plan was increased from $35,000 to $60,000. The entrepreneur's incentive was also introduced. It's a lower or a smaller capital gains inclusion rate for entrepreneurs. The most notable change that you may have heard of already is the capital gains inclusion rate is increasing from 50% to 2/3, or 66% of gains, starting June 25th of 2024. Individuals get a $250,000 exemption to this increase, while corporations and trusts have to deal with this higher inclusion rate on the first dollar of capital gains. This has outraged many tax and financial planning experts. They're so mad in LinkedIn that they're copying and pasting whatever their head office is telling them to do. There are a few items here that I have to go back and review in more detail because this video will focus primarily on capital gains. What I'll do here is walk you through how this actually impacts Canadians and why I believe it's not just the 0.13% that the budget claims to be affected. To make this as practical as possible, I'll have to walk you through the basics first. How that compares between what we're paying now and what happens in the future if the proposals are passed. I will also point out how this may likely impact you as an individual and how it will impact somebody who is employed and compensated through stock options, as well as how it impacts individuals who are incorporated as professionals or own their own business. It'll also impact trusts. It'll impact real estate investors and families with multiple properties that are planning for the next generation. It'll also impact renters, and not in the way that they are proposing. I'll cover whether this change should prompt you to realize your capital gains now or wait until you have more information. So let's get started with the basics. First, let's get over the basic system. The tax system is an overly complicated incentivization and disincentivization system. For the most part, I want to believe that it still incentivizes us to look after our own benefit long term. So I'll show you how. If you earn a salary or T4 income, all of that is included in your taxable income this year. Let's say you already earn $100,000. All of that gets added to your taxable income. Based on the 2024 tax rates, you'd pay about $23,000. If you earned an extra $100,000 on top of that, perhaps through a bonus or a pay increase, it's the same thing. All of that extra income, whether that's salary or bonus, gets added to your total income, bringing your total taxable income to $200,000, and you'd pay $60,381, or an effective tax rate of roughly 30%. On the other hand, if you earned this additional $100,000 of income in capital gains, let's say that happened by selling a rental unit or a secondary property. Perhaps you sold this property for $480,000. That would be your proceeds of disposition. However, any costs to finalize the deal, such as commissions to your realtor and legal fees, will be taken off. So any outlays and expenses that will go against your proceeds of disposition. In this example, let's call it $20,000. And you bought that property for $350,000 way back in the day. Right now, for example, when you bought it is irrelevant. You paid $350,000 to that and paid legal and other acquisition expenses totaling to about $10,000. So your total cost to acquire this is $360,000. This is known as your adjusted cost base. To determine your gain, you would take your proceeds of disposition, $480,000, less adjusted cost basis of $360,000, and less any outlay to sell, $20,000 in this case. This means you'd have a total gain of $100,000. Currently, only 50% of that is included in your taxable income. So your new taxable income would be $150,000 in our example. You'd pay about $40,000 or a 20% average or effective tax rate. I walk through this because I have repeatedly heard people say that the capital gains are now taxed at 66%. That's just not true. The new budget is changing what you include in your taxable income from 50% of the gains to 2/3 or 66.67% of whatever you make, considering our calculation as our example. What will happen instead is now you would have to include $66,667 of that $100,000 gain. Total taxable income in that situation ends up at $167,000 roughly. Instead of the $150,000, the new tax total is $46,000 instead of the $40,000 we were anticipating before. But wait, that's not really where this proposal ends. The new budget proposes that the first $250,000 of capital gains any given year per individual is exempted from this increase. So the first $250,000 of capital gains will still have the same 50% inclusion rate, and any capital gain thereafter will attract the higher 2/3 example that we are now proposing. If this was the only effect, then I would believe that the statement that only 0.13% of the population would be impacted, because very, very few people have capital gains that exceed $250,000 any given year. So if you have a large home equity in your rental portfolio, you can simply go around this by making sure you don't liquidate all of your units all at once. The issue is if it's only one building. Now, if you're married and have a common law partner whom you share and invest your wealth with, the capital gain is also split into your proportional ownership of the property. So theoretically, if you and your spouse own the properties equally, you don't need to be so concerned about capital gains inclusions changing unless your gains will exceed $500,000 as a couple. Now, I walk through this example because I've heard, and in fact, I've been asked whether it makes sense to sell properties now before that June 25th, 2024 increase in inclusion calculations. While I can't answer the DMs, I can now say for the most part, unless you're triggering a $250,000 capital gain, in this example on the walkthrough that I just showed you, there's really no rush to sell if you own these properties or these investments personally and not in your corporation. This example actually also does one more thing. It further highlights the importance of income splitting and asset splitting. You want to make sure that to your best of your abilities, you and your spouse own your assets equally. In my example, I used real estate, but it pays to make sure you're balancing the ownership of your investments, including non-registered or trading accounts. Registered accounts like the RSP, the RIFs, TFSA, RESP, and RDSP are not affected by this, and that's also the same with pension plans. You don't have to worry about your defined contribution plan growing and how that's being invested. So for most individuals, we're not really affected by this until much, much later. If we pass without a surviving spouse, that's likely when most of our properties, cottages, family land, vacation homes, and of course all our non-registered investments will be deemed to have been sold or disposed of. So if I passed, most of my capital assets would be transferred to my spouse on a rollover basis and vice versa. So no taxes are triggered, at least not if I don't opt to do so. There are planning reasons to do that, but for most people, it just defaults to a rollover. Without a surviving spouse, all of this becomes taxable to the estate. When you consider all of your investments and everything that you've accumulated throughout your life, that's likely when it'll exceed the $250,000 threshold. According to Royal LePage, 4.4 million Canadians currently own an investment property, and this is an old statistic. That's clearly more than the 0.13% this budget claims that will be affected by this. So for most individuals, just pay attention with what you're selling and make sure you defer to your accountant or your financial advisor, your financial planner, before you make rushed decisions. Because unless you have a massive portfolio and you have a massive capital gain that you're already planning to sell in the near future, I really wouldn't treat the June 25th change as a deadline. Now let's talk about trusts and corporations. The $250,000 threshold for the new higher capital gain inclusion does not apply to corporations. So this change is actually more punitive for them. In fact, I would say this was really the targeted group of this budget: small business owners and incorporated professionals. Many of them invest within their corporation or their holding corporation as a retirement account. Just like me and you would choose a different investment account, they're just doing that because it's more tax efficient. And really, a lot of them have done that with expert advice being given to them. But in the name of fairness, this budget has targeted small businesses, professionals, regardless of how divisive it actually is. Remember, behind each business is an owner and their family, many of whom have put unquantifiable sacrifices to get their businesses off the ground. Years of little to no income when they're launching and reinvesting everything back into their business at the risk of their own security. In fact, many small business owners don't even have CPP contributions in their early years, and it's not by choice. I'll have to create a separate video for this since it's a large topic, and I'll have to coordinate this with a new entrepreneurship and incentive that they're also launching. But here's the summary of how this affects small business owners on a year-to-year. Ever since 2019, passive income can raise taxes on a qualified small business. See, the first $500,000 on a small business's active income is taxed at a lower tax rate. However, that $500,000 can be reduced by $5 for every dollar of passive income after $50,000. So eventually, it will be wiped out if a business earns $150,000 in passive income, which, to no surprise, includes capital gains. That is a hell of a lot easier to accomplish, to get that much passive income, if capital gains are now being taxed at a higher inclusion rate. So not only will the investment income in the corporations potentially be taxed higher, so too their active business income. This impacts your doctors, your dentists, and any incorporated professionals, as well as business owners who plan on using their holding company to just simply store money for their retirement. The reason I feel like this is the group that really got targeted by these measures is the budget actually lays out a larger than expected tax revenue from corporations in 2024. It's almost like they wanted to force corporations to realize capital gains before June 24 this year. Now, employees and executives who are compensated through stock options will also be affected. This is because the taxation of stock options has a provision that uses a 50% deduction based on qualifying options. That somehow mimics capital gains. Now, that will have a reduced deduction after the $250,000 threshold, since this limit is shared with capital gains. Now, if you receive stock options as part of your total compensation, part of the proposal is to reduce the stock option deduction to 1/3. This coordinates with the 2/3 inclusion that's now being proposed. However, you can still use some of your new capital gains threshold, that $250,000 that we're talking about, to coordinate with your employee stock option. So your capital gains outside of your employment and your stock option compensation will both have a 50% inclusion rate until the $250,000 threshold. Be sure to coordinate your investment income and the income that you're going to receive through work when you're considering your total compensation. Let's move on to trusts. Just like corporations, trusts do not have the first $250,000 of capital gains as a threshold. And just like corporations, trusts are subject to extremely complex and nuanced taxation and tax provision. Generally speaking, if done with proper guidance and with proper advice, creating a trust shouldn't be focused primarily on tax savings alone. There are other reasons to utilize a trust for your family and your financial situation. Now, this becomes significantly more complex since most individuals who find trusts suitable typically own and operate their own businesses. So it's a dual whammy for a lot of these people. And if you're experiencing that and you want help navigating all of this, feel free to reach out. Check out the links below. That was a plug. I get it. Now, so you can almost guarantee that anybody that is facing complications with planning around a trust is essentially battling all these changes from multiple fronts, including their business, and to now have to make adjustments to change their family plans as well. Speaking of families, let's talk about families with multiple properties. I already used real estate as an example earlier, so simply refer to the capital gains basic calculation section, but I want to review the expanded implication of this. We all know that the Canadian real estate market is insane. It's something that I consistently think about. How do I help my siblings? How do I help my kids get into their properties? And incidentally, this is also usually within the top 3 concerns of the clients that hire me. So I know that this resonates with a lot of retirees. In fact, it's not uncommon for older Canadians to get a line of credit or maintain a mortgage so that they can get access to some of their home equity and use that as a down payment for their kids. If you have the means to help your kids and your grandkids get their first property, wouldn't you? I sure as hell would. Some of these clients, even before we've met with us, borrow and take out mortgage on properties so that they can get the properties for their children. This is where this gets complicated. That property, if you bought it for your kids, that doesn't count towards any primary residence exemptions. When the kids are finally ready to take over and they take your name off of the title, that's now a deemed disposition. By the way, this is also true even if you're only a partial owner of your children's property, which typically happens when you co-sign for your kids' mortgages. The gains would be subject to common capital gains inclusion rates, whatever it is at the time. So even with the $250,000 threshold, depending on which part of the country that real estate is in, it can easily exceed this $250,000 threshold. So that results in a higher tax overall. And this is for somebody that's just well-intentioned. They're just trying to help their kids and help the next generation, which, by the way, was repeatedly mentioned in this budget, helping the next generation. So if there's a family that's going out of their way and they're working really hard to make this happen for their kids and their grandkids, why are they being penalized? So I just want to make sure I bring that up in another tidbit for you to consider if you're doing this for your family. This potentially exposes you also to double taxation. So when you do a deed transfer or a title transfer, and when your kids finally get full ownership of whatever the properties that you bought, be sure to confer with a professional, because you could be subjected to double taxation if that transfer doesn't happen at fair market value. Let's move on to the real estate investors. If your investment strategy relies heavily on capital gains, be sure to rerun your math. This higher inclusion rate means that your after-tax rate of return calculation has just changed. Now it may make more sense to employ a BRRRR strategy instead of selling your properties, or if you were undecided about rebalancing your portfolio and you were hoping to hold on long-term anyway, perhaps now really focus on cash flow more than you ever did. Make sure that your investments meet your target rates of return, even with a lower back-end profit. For renters, this is where this gets a little bit, unconventional. Now, there's a lot of measures in this new proposed budget that discusses making rent more affordable, but I just want to walk you through how this budget may actually lead to higher rents. I have met and worked with many clients who own and manage their own real estate. And if I'm being honest, most of them, including myself at one point, are really relaxed about their present numbers. Most of them are okay breaking even or even being slightly negative in their monthly cash flows if the tenants are easy and there is a big payoff when they eventually sell that property. If the math for the capital gains in the back end looks worse than it previously did, these previously relaxed investors will now be more mindful of the cash flow. This means that they are quicker to adjust rents. And if you are a renter and you haven't had a rent increase in a while, even in the midst of these rising interest rates, this may be the final trigger. So I know that's a lot. Be sure to stay tuned because there were a lot of quick items and bullet points that I talked about in this video that will likely be seminars and videos on their own. This next video right here on the screen will integrate a lot of these ideas in your own retirement. Until next time, remember, you can be your own money hero. Bye!